Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate all the comments, subscribers. Thank you so much. Definitely check out the comment section. A lot of value investors digging through the comments, suggesting fantastic stocks. Really appreciate it. Thank you very much. This week, we are going to do General Mills, the giant cereal conglomerate, and we're going to see what we think they are worth. We're going to look into the public market to see what the share price are trading at and see what kind of economic return we can get by holding the shares. Ready to do this? Let's do it. All right, so this week we're going to look at General Mills, but before that, let's review our 5 key attributes for all of our investing. We need top-line revenue growth. We need earnings growth, be it EBITDA. We need strong free cash flow. We need low debt, and we need a well-priced stock. Those are the 5 key attributes that we use to evaluate all of our stocks. Let's dig into General Mills right now. So behind me is the revenue and EBITDA for General Mills for the last 9 years. These are in dollars, in millions. And what you're going to see is a wildly mediocre tale for such a beastly company. I would expect a whole lot more. They did have a recent pop from the COVID-related cooking from home. Great. But is that going to continue going forward? Who knows? But let's take a look at long-term. What have they been doing? How have they been investing their capital? Have they been growing? And from $16.6 billion in 2012 to $17.6 billion in 2020, that's $1 billion growth in 9 years. It's not exactly putting the lights out over here, 0.7%. So that is a positive number. So I guess in our criteria, we look for positive revenue growth, which this does check that box, but it's barely a check at all. So we're going to keep that in mind. I'll check that box technically, but then how much do you want to really rely on 0.7% annual revenue growth? Okay, that's revenue. Let's take a look at EBITDA. EBITDA, kind of the same tale here. $3.2 billion to $3.7 billion over this time frame, largely flat. Look at that. Now, they did manage to get a little bit of margin expansion over this time frame, 1.9% annualized growth rate versus 0.7, but neither of these numbers are something to write home from, and if something should happen to the economy and so forth, they could both be negative fairly easily. So I think this is a concern for us. Technically, they're going to check the box, but we want star performers, right? We want just like people who kind of just meet the criteria. We're looking for the truly the top 1% of the stocks out there because we have a limited portfolio. But we'll get to that in a second. Let's keep running through these numbers. Enterprise value begin with short-term and long-term debt. For these guys, debt is growing, which is a concern. You should see this and you should think right away multiple of debt going up. Why? Because debt has gone from $7 billion to $13.6 billion on relatively flat EBITDA. We just covered that. EBITDA here, relatively flat. This number growing, that's a doubling of debt. What does that mean? That means our debt ratio is going up. That's absolutely right. We'll cover it in a second. Let's finish our enterprise value calculation. So we got debt, less excess cash. They don't have any excess cash. It's all used in the business or paid out as dividend. They need that cash. They don't have a treasure trove of money. Market cap, that's shares outstanding times average price. Average price for me is May of the month of the average of May for each month because that's the end of their fiscal year. I get market cap. I add these two together, I get enterprise value. Again, if you're new to the channel, enterprise value is the entire business. That's the way we want to look at it because the amount of debt that they put on the business, that's a management decision. If you were to fire all management and install a new CEO, a new CFO, they could say, we want to be debt-free. And they would use their cash flow, pay that debt off, and then all the earnings would flow to the market cap. But this enterprise value wouldn't change. The value wouldn't change. This column would transfer to here, and the enterprise value would stay exactly the same. So what we want to look for is the value of the enterprise. That's everything. Think of your house, right? If you have a house and you have a mortgage, that's the debt, and then you have the equity behind that. The house value doesn't change. If you were to sell the house, it's the public value. How much you keep for the sale, that's your equity. That varies depending on how much debt you have. Same thing here. So enterprise value has gone from $32 billion to $50 billion kind of a combination of both market cap growth and debt growth. Let's get to a couple ratios to help us gauge what does this mean in terms of payback period and how much debt do they have. So we'll do the debt first. Net debt to EBITDA. That is me taking the total debt divided by EBITDA. And like we said, it's growing. That's right. 2.2% to 3.7%. That 3.7 is above our 3 times ratio. And it looks like it's been above there for several years. They are trying to bring it down. I'll also comment that 3.7 is barely above. So if I wanted to, we could check the box. I'm not going to check the box because I think it's been above it for several years. Weak revenue growth, weak earnings growth. It seems to me that they're levered up and they're not able to use that leverage to go grow. Enterprise value to EBITDA, that's our payback period. That's how much earnings the business generates relative to the value of the entire enterprise. You can also think about it as a payback period. If I bought the enterprise now at $50 billion and it generated only $3.7 billion of annual earnings, it would take 13.6 years for the business to generate enough cash to pay for itself. It's a payback period or a relative basis. You want to see, obviously, this as low as possible, means you get your money back really quickly. Not you specifically as the stockholder, but the business, the enterprise is generating a tremendous amount of cash. It seems like it's fairly flat to me, right? 10 to 13 times. That's because there's not much growth and this sector isn't like a subscription model. It's not a super hot sector being cereal and basic foods. So the trading range on the market multiple is fairly limited. It's fairly stable. And it does look like that number is relatively at the high mark, if there is one, of 10 being low, 13.5 being kind of high. So it seems to me like it's pretty fully valued, has limited revenue, limited earnings growth, and has a lot of debt on it. Not checking a lot of boxes for me, right now. Let's take a look at cash flow, and we'll see what cash flow looks like. Okay, let's dive into my personal favorite statement, the cash flow statement. And we're going to pick up with cash flow from operations. That's the first third of the cash flow statement. Cash flow statement being the third statement in the financial statement. Typically, it's presented balance sheet, income statement, cash flow. Cash flow bridges the two balance sheets. Two balance sheets being two different fiscal periods. 2012, $2.4 billion of free cash flow from operations, or cash flow from operations. 3.6 billion. So that's definitely a move up. That's $1 billion. That's about the same growth that we saw year over year in revenue. It's translating to earnings, cash flow, which is fine. Cash flow is growing slightly faster than EBITDA, but both directionally kind of low single-digit growth rates means that at least accounting is doing a good job expensing costs appropriately. So the P&L and income statement, the P&L and cash flow statement are jiving, which is good, but this growth isn't fantastic. What I do like is this spread here. So you got CapEx, that's how much money they need to reinvest in the business, how much money they need to build factories, build new production lines. This, call it $500 million a year, is maybe 20% of the actual cash that they generate. So that means most of this money can pass through to the equity holders or go to satisfy debt, which is a good thing that we want to measure. The problem is all the debt they have sucks that cash up. So let's walk through that. They made $3.7 billion last year. Great year. Kudos, General Mills team. They put back half a billion, $500 million, rough rounding here, back into the business. So that leaves about $3.2 billion of available cash. They had to pay down debt of $1 billion. That's cash that could have been used to grow, could have been dividended out, but they have to pay down the debt because they are recognizing that they're too highly levered. And you can see that they borrowed big here, and the last couple years they have been making big payments to kind of bring that number down, and we are seeing that multiple come back down with time, which is a good thing. But nevertheless, that's $1.2 billion that didn't get to the equity holders. It had to go pay back the bank. And this should be rightfully your money, but they levered the company up too much over time. So if I'm looking at free cash flow, which is to equity, which is the value of a business, which is the underlying, is why you buy the business. It's for the dividend, it's for the growth. All that comes from this number here. Well, this number's lower because they had to put down money on debt. So right now it sits about $2.3 billion, which is decent, but it should be a good $1 billion higher if they were debt-free. They are using some of their free cash to buy back shares, albeit very little. It is coming down slightly. Cash flow per share, share price, and a yield. Aside from this particular year here where they borrowed a tremendous amount, I'm looking at average yields in this range, which is about 5.5% over time. That's what the stock trades for as a yield on the free cash flow, about 5.5%. ROIC was nice at 15%, has come down a lot over time. So I think that is kind of a concern. Generally, company equity returns, stock market returns tend to resemble long-term return on invested capital. If you think of it this way, this is what the internal return the company, are receiving on their invested cash. So long-term, the stock performance should reflect the return on the invested cash within the company. So as this is coming down, I think that means that the stock itself is going to slow in growth, and it's going to approach kind of a market return. I mean, 10, 11% should be where it might land long term. So now let's forecast. First thing we're going to forecast is free cash flow. So my forecast is $3.86 for next year's earnings. I'm basically averaging the last couple years because they've made debt payments. I want to include that I think cash flow is going to be a little low for the next several years as they pay down the debt, but it should grow. I'm growing this in line with the EBITDA that we've seen historically, so I don't think it's going to move too much. I just gave it a very weak growth rate reflecting what they've been doing historically. I'm not willing to underwrite a higher growth rate or some sort of major acquisition, or that's all guessing. I want to know base case, what I'm willing to put my money against, and basically guarantee. I can guarantee that I can guarantee you, but if it were my money, I would be saying I could guarantee to myself that they're going to grow 1.5%, 2% a year for a decade. That means I get $4.56 long term. Remember, our average free cash flow yield, 5.5%, gives me an $84.88 price target out long term. Let's take a look at EBITDA. EBITDA, same story. I pick up last year's EBITDA. I grow it at the basically 2%. Run it out. I get a long-term target of $4.4 billion. I apply an average of 12.1 times multiple. I'm just taking the average that they've experienced in the last almost decade. That's where they should be. That gives me an enterprise value of $53 billion. Less debt. Remember, they still have some debt. I'm using a little less than 3 times, thinking they're going to buy that down of debt. Subtract these two, I get a market cap of $41 billion, divide by current diluted shares outstanding, 606 million, gives me a $68 price target on an enterprise value basis. Okay, so now we have two pricing estimates. We've got a free cash flow basis and we have an EBITDA market multiple basis. We're going to average the two to come up with a base case that we can use on an IRR. So here's our two. We've got 84.88 on the free cash flow method, and we've got 68 on the EBITDA market multiple method. I'm going to split the difference and say long-term $76 is about where the stock should be in 10 years from now. If I look into the public market, I can buy it right now for $60. I'm going to get this stream of cash flow, which is after this large debt payment that they have to make. I'm going to sell the stock long-term at $76, and that's going to give me a kind of net cash flow stream of me coming out. It's cash and $81 back to me. Obviously, you're not going to get all this in cash. They're going to pay some to you in dividend, some they're going to use to buy back shares, which would make our share count lower than I used, which means this would be higher. This is a financial exercise to illustrate the total free cash flow of the company and principally what you should yield over the long term. on this example is 10%, which is wildly market. So it's 10% IRR, basically 2 times your money, holding a very conservative basic stock for the long term. Let's review our 5 key attributes. Top line revenue growth, yes. EBITDA growth, yes. Strong free cash flow, yes, the cash flow is strong. Low debt, no it's not. Well priced, meh, kind of. I'm gonna give it a meh, right? So I'll check the box on well priced because it's not over expensive, but a 10% IRR forecast is market. And for the company to have very low, if not anemic revenue growth, low single digit EBITDA growth, there's too much risk there for me that could turn negative, and this number could fall dramatically over time if they're unable to grow. I also don't like that they have too much debt on them. For such a simple business, they should have very low debt and be just a dividend machine. But almost $1 billion going to pay down debt every year when they have free cash flow of maybe $3 billion, that's just too much of the free cash flow tied up into debt payments. I think General Mills should take a year or two, lower the dividend, drive down the debt payments down to maybe 1 times, then turn dividend back on, and then they'd have also growth money to go out and make growth acquisitions and grow the top line. This company is sandwiched between 2 things: debt that they have, which is too high, and the dividend payout, which is too large. I'm going to show you that right now. Okay, before I end this video, I want to go through what General Mills is using their cash flow for and what I would suggest that they do instead. What I'm going to do is I'm going to go to the cash flow statement, and we're going to come down and look for dividend payments. So cash flow from operation, cash flow from financing, cash flow from investing, cash flow from financing, dividends paid, right there in black and white. $1.2 billion, 1.1, 1.1. So about $1.1, $1.2 billion they are paying every year in a dividend. Well, if I go over and look at their free cash flow here after debt payment, that's averaging $1.6 billion. So they're making, on average, $1.6 billion of free cash. Out of this comes the dividend payment. So 1.6, 1.2, that leaves about $400 million left as cushion for in case stuff, to be like the acquisitive and go buy companies. They don't have much cash. They can't accelerate the debt buy down too much because of that cash is weak. So I think this company is sandwiched between having too much debt and having a dividend yield that's too high. Can they afford the dividend? Absolutely they can, at the expense of growth. So what you're getting here is you're getting a company that can pay the dividend. If that's your investment thesis, that you want cash flow, it can totally make it. But as a sacrifice, it's never going to grow its top line at any decent rate for me, so I'm a pass. And we're going to give it, here at the channel, a meh, like I said earlier, because honestly, there are other opportunities that have better growth prospects and a pretty decent dividend that we could find. Okay, I hope you liked the review of General Mills. This is Rational Investing. My name is Cameron Stewart, CFA. Let me know what else you want to see, comment, and hit the subscribe button. See you next time. Bye-bye.